Hi there. Welcome to the Open on BNN Bloomberg. Quite the rally in markets. Oil prices under pressure after the Americans and the Iranians agreeing to a ceasefire. We're going to be all over that. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Algoma Steel has entered into a joint venture with Rochelle to create an outfit called Rochelle Algoma Defense Solutions. Rochelle is a Southern Ontario-based defense manufacturer, and it produces smart armored vehicles. The goal is to make ballistic steel for armored vehicles for Canada's defense industry. Both companies say this steel can be used for other industries, including infrastructure, marine, aerospace, and security. And there's a look at Exxon in the pre-market, down about 6%. The company says 6% of its global first quarter production was knocked out due to the Iran war. It, of course, affected much of the energy industry in the Persian Gulf. First quarter earnings at Exxon's Energy Products division will be $3.7 billion US lower than the previous quarter. The US oil giant attributes this to price volatility and the timing of cargoes. Shares in Delta jumping in the pre-market. First quarter profit on operating revenue at the giant carrier beat analyst estimates. The company said demand has improved and bookings were strong in March. Premium cabin and loyalty-driven revenue cushioned the impact of higher fuel costs. The airline said it expects to incur more than $2 billion in higher fuel expenses. And you can see U.S. futures sharply higher, equity futures sharply higher on word of this ceasefire. Let's have a look at how the TSX traded yesterday. It got a boost from oil hitting $115 US in North America, the futures. Let's have a look at oil, speaking of which. And you can see down radically, down almost 20%. Of course, the oil futures have been a bit misleading this week around the world. Actual oil for delivery in the physical market has been trading at more than $140. Let's have a look at gold to see how it's faring. It's up. Perhaps this news means we won't get as much energy-driven inflation, so that could push off the prospect of interest rate hikes. And those hikes are generally seen as bad for gold. And let's have a look at the Canadian dollar. And it is hanging in today above 72 cents US. And finally, Bitcoin. One of the ideas behind it is to act as a safe haven if people are worried about the stability of global currencies. Right now, it hasn't been doing much lately, though, but it is above 72,000. For now, investors seem to be betting that U.S. President Trump really wants to end the war in Iran. We just saw U.S. equity futures soaring, and a major slide in oil futures. Right now, there's the possibility that Iran will open the Strait of Hormuz to vessel traffic in the near future. Let's get perspective from Paul Harris, portfolio manager at Harris Douglas Asset Management. Paul, great to see you. It's early days, I know, but so far a pretty euphoric reaction.
Yeah, well, congratulations on your retirement, first of all.
Thank you. There's a euphoric reaction to that as well, Paul. Anyway, carry on.
I'm sure there was, actually. So it's always been a pleasure talking to you. So a couple of things. One is that obviously what's happened right now is that when you look at the market is really, priced in most of the stuff already, right? So you've seen this massive rally in the market. So, a lot of things can happen in 2 weeks, and one hopes that you come to some kind of conclusion that this will end and that we'll move forward. But there are still a lot of very sticky points, right? I mean, yes, you've degraded Iran's ability, their government, their people that run the government. You've degraded their, some of their missile ability. Their who knows about their their nuclear ability. But you've also created a problem where they feel emboldened from being able to close up the Straits of Hormuz, right, very easily if they wanted to. So I think you've created a very difficult problem for the world. And the other issue I think is very important is that Iran really showed their ability to attack their neighbors, and which are very strong U.S. allies. So the U.S. ability to say that we're going to protect Saudi Arabia and United Arab Emirates and Kuwait is much more difficult. So I think it's a very awkward situation. I think that there's 2 weeks is not a lot of time, to be honest with you. But I mean, hopefully they come to some kind of conclusion that allows for us to stop seeing this happening. But in the event of all this stuff, like you've seen what happened today, but although it's been incredibly volatile on a day-to-day basis, prior to this move today, the market wasn't down that much, right? I mean, the S&P 500 was down 4% as of yesterday. It's kind of flat for the year to date. You've seen, the VIX even, which is a measure of risk, was never really kind of blown up to the highs of 40 or 50. It really sat around, the highest I think it went to is 31. So the market really never capitulated at any of these things, because I think of the way, the structure of how you get news and, the volatility of everyday events happening like this. So I think that, it's a wait and see. I think there's more volatility to come. I think that it's a good opportunity at times to buy good businesses if you see the volatility in those companies. And I think that's what you have to look for if you're a long-term investor, kind of try to look past all this stuff, especially the volatility.
If for money in bonds, you think minimize risk and stick with short-term fixed income?
Yeah, so I think, if you look at what happened in the short end of the curve in the United States and Canada, you've seen this sort of those yields go up a lot. And I think, there's an opportunity because I think people felt that there was going to be inflation, the Federal Reserves and banks, central banks around the world were on a hold to wait to see what happens. So the short end of the curve really backed up a lot with interest rates going higher there. And so I think that there's an opportunity to be in the short end of the yield curve in Canada and the United States and make I would say a less risky rate of return with if the war sort of doesn't stop and continues. And I think you've seen a rally in the short end of the curve right today, right? Because you've seen people feel more comfortable that inflation is not going to be an issue, that the Federal Reserves and central banks around the world will have the ability to at least leave rates where they are, right?
Let's maybe have a look at a 5-year chart or 1-year chart. And there's the Canadian 2-year bond yield. People buying 2-year bonds today, pushing down the yield. Let's have a look maybe at a 1-year chart for the TSX Banks Index. You think Canadian banks look like a reasonable bet right now?
Yeah. So if I had I own Canadian banks, so yes, I think it's gonna it's gonna be, they had a great year last year, and I think that they've pulled back and they will continue to do well. I think that I think U.S. banks have a better opportunity, or Canadian banks with a larger U.S. presence will do better. I think there's a lot of, the issue for me is when you got regulatory changes from a capital perspective, so loosening up their capital restraints, which helps banks there a lot, so they can deploy capital to other businesses or buy back shares or increase their dividend, which I think a lot of banks can do. So I think that's one important thing that's happening in the United States. The other thing that's happening in the United States, I think I think for the first time in a long time on the banking side, you're seeing a lot more bank consolidation or financial services consolidation. And I think that'll continue to happen. The Trump administration does not seem to be object to a lot more common M&A deals going through, especially on the financial side. And certainly in the U.S., there's way too many banks. So I think that consolidation will continue to happen. So there's good opportunities of regional banks, good opportunities, I think, for money center banks who have the ability to expand their businesses, either through organic growth, but also the reality is that they can reinvest in a lot of their other businesses because they have a lot more capital to do that, where they weren't being forced to keep capital on their balance sheet to manage a regulatory environment. So I think there's a lot of good things about the banking industry in Canada. I think banks continue to do well here. I think that the banking industry has been a great business. That although banks have, they're not as structurally years ago, they were stuck in a very different world because they were mostly lenders of money. Now they're much more capital. Their capital is used for investment banking and credit cards and asset management. So they have their fee income is much higher than it was. So they're much more stable in that respect, right? So, and I don't think you're going to see. I think the mortgage market is going to get better. I think housing will come back a little bit over the next year or so. I think you've seen little bits of that happening so far. I think this was the last month was one of the best months in the housing market. So I think those things are all coming back. I don't, hopefully you don't see rate rises, which hurt the mortgage market. But I think generally banks in Canada will do well.
Thank you so much, Paul. Paul Harris. Coming up, America and Iran agreeing to that 2-week ceasefire. Tehran promising to reopen the Strait of Hormuz. We'll update you right after the break. So there's going to be a ceasefire of 2 weeks in the U.S.-Israel war against Iran. Tehran promising to reopen that crucial Strait of Hormuz. Let's get the latest from CTV's Scott Hurst. Scott, great to talk to you. Quite a dramatic turn of events. How did the two sides come together at the last minute?
Andrew, good morning. Let me start with this. Global leaders are praising the ceasefire agreement in a joint statement that included Prime Minister Mark Carney, as I mentioned, praises and welcomes the 2-week ceasefire, thanks Pakistan for facilitating the important agreement, but goes on to say the goal must be to negotiate a swift and lasting end to the war within the coming days, and it says that can only be achieved through diplomatic means. Now, as you mentioned, this has been a dramatic turn of events as the U.S. president in a few short hours went from threatening to annihilate Iran to saying the U.S. will stop bombing for now and work towards a lasting peace deal. Of course, this is a significant de-escalation, but as you might expect, it's incredibly fragile, it's tentative, and temporary 2-week halt in the fighting. As the U.S. president said on social media, Iran put forward a 10-point proposal that he initially claimed is a workable basis on which to negotiate, but then later called it fraudulent. As some of the main points by Iran include the lifting of sanctions, the release of frozen Iranian assets, a U.S. military withdrawal, and continued Iranian control over the Strait of Hormuz. Now, Iran says it has accepted the terms of the 2-week ceasefire, and it would negotiate with the United States in Pakistan, Andrew, beginning on Friday.
Is there any clarity on how quickly the Strait of Hormuz will be fully reopened?
Still lots of uncertainty, specifically when it comes to the Strait of Hormuz, as the temporary ceasefire, according to the Americans, according to Trump, depends on the complete, immediate, and safe reopening of the crucial waterway where so much of the world's oil passes through. The Iranian foreign minister, on the other hand, says safe passage will be possible only with the coordination of Iran's armed forces, and reportedly Iran and Oman will charge fees on ships to navigate the shipping route. The U.S. president, however, again saying on social media, the U.S. will be helping with traffic buildup in the Strait of Hormuz. So what happens in the immediacy and what happens over the next 2 weeks at this time is still very tentative, but incredibly crucial to see what specifically happens with the Strait of Hormuz, how quickly it can get back up to capacity that allows ships to pass through, and also ultimately what might be able to come from the 2-week ceasefire if it can lead to more of a lasting peace, Andrew.
Scott, thank you very much indeed. Scott Hurst, our colleague at CTV News. So we're going to be drilling into the implications of this 2-week ceasefire deal. Investors reacting jubilantly today, but there's lots of lot of questions out there as to how this agreement is actually going to be implemented. We'll have more, including the surge in the price of oil and gas, right after this. Oh, I should say, sorry, the drop in the price of oil. What am I talking about? Thanks very much. We'll be right back. Let's get more on the ceasefire deal from Andrew Peake, director at the Atlantic Council Scowcroft Center, and former senior official in both Trump administrations. Andrew, thank you very much for joining us. One interesting point seems to be here that Iran has, it seems, de facto control of the Strait of Hormuz right now.
Right. So a few key points in the ceasefire were left unadjudicated, right? What happens in Lebanon if the ceasefire applies to Lebanon? What happens to the control of the Strait of Hormuz? Does Iran get to charge money on ships going through there? The practical effect of the war has been to lower the political cost on Iran of enforcing its military control of the strait. I mean, Iran, because of its geography, always has a latent control of the Strait of Hormuz. But ordinarily, if they shot at ships trying to transit it, they'd bear a tremendous political and potentially military cost. I think the ceasefire can work for the U.S. in this respect because it has temporarily now re-raised the political cost for Iran of breaking the ceasefire. If you have merchant ships try to pass without paying Iran, especially if they're escorted by U.S. or allied ships, this would put Iran in the place of essentially breaking the ceasefire and even challenging U.S. naval vessels.
So is this a major victory for Iran then, in that sense?
I'm going to have to give you the really unsatisfying answer of it's too early to tell. There's so much that's unadjudicated in the two different competing claims about the diplomacy. You have President Trump this morning referencing the 15 points the U.S. transmitted as the basis of negotiations. Yesterday, it was Iran's 10-point proposal. There's so much unknown right now, but I will say I've always thought that the U.S. could walk away and still call this a victory because of its degradation of Iran's military threat, i.e. basically take the approach that Israel takes to Lebanon and say, okay, we set Hezbollah back 5 years, and that's now a victory. We could take that approach with Iran and say we've diminished their capabilities and reduced their threat to the region. They no longer have clear control of the Strait of Hormuz. And so now we're good with that and let Iran dig itself out of its own hole. So I think even though the diplomacy is very unclear, I think you still could call that a win.
That's it. That is interesting. We've certainly learned, though, that with pretty low-tech weapons, fairly relatively cheap weapons, Iran has been able to shut this crucial waterway.
Yeah, absolutely. I think the risk tolerance for merchant shipping was much lower than we probably thought. That even if there was a chance that Iran, with very cheap weapons, as you say, what we would call asymmetric weapons, low-cost, high-yield weapons, could inflict damage to them, that they would then shy away from transiting the strait. I think what we found with Iran in the first term was that even when our allies, the Europeans and in the Gulf, weren't overjoyed about what we were doing with Iran, our Iran policy, like withdrawing from the Iranian nuclear deal, that Iran's behavior, its missiles, its proxies, would eventually push them onto our side, even if they didn't want to start out there. So how that applies here is, I would suspect that the permanent Iranian control of the Strait of Hormuz, especially if they have to start enforcing it by firing missiles, is so anathema to states, the region, and other states in Asia and Europe, that there will be more of an international effort to establish a fait accompli of free passage of the strait and not let Iran just grip it.
Right. And a point you're making is that if ships start going through without getting agreement or paying a pound of flesh to Iran, the Iranians go after them, they would be in the position of breaking the ceasefire and or having to actually get into tangles with navies of G7 countries and other U.S. allies.
Exactly. So the situation is actually better than it was 48 hours ago for the U.S. because that additional political and military cost is now on Iran. We'll see if it lasts, for the next 2 weeks.
President Trump saying that he has achieved, quote, regime change in Iran, which seems pretty obviously off base here.
Well, I think going by the Venezuela example, you can go through a few iterations of leadership and cause the regime to rethink some of what they are willing to settle for in diplomacy. I think there are versions of regime change that we can talk about that have proved successful in South America that we can now look at in Iran. What I would really be looking at is how Iran's negotiating position has changed from where it was, a month or two ago. Historically, they've never been willing to talk about missiles. They've never been willing to talk about proxies in a diplomatic setting with us. They've never budged on any kind of uranium enrichment issue. If they start to talk about those things in a tactile way, in a way where it involves putting positions on paper that are less maximalist than their original positions, then I think you could have a legitimate argument saying, okay, there's a new leadership in Iran that is equally committed to regime survival, but thus is willing to play a little bit more ball on the diplomacy.
Iran and Russia have been working together. Russia, for example, using Iranian drones in its war in Ukraine. How does Russia fit into this? Is Putin, obviously Vladimir Putin was happy to see higher oil prices.
That's right. And that's where Russia and China, though they are strategically allied, their interests in the Middle East differ. China would very much like lower oil prices, and Russia, of course, as an oil producer and exporter, would like higher prices. Russia has suffered a series of setbacks in the Middle East since 2015. It's kind of apogee when it helped Assad stay in power and turn the tide of its civil war. Of course, the loss of Syria, the loss of the Assad regime was a huge hit for them, as well as the attack last year, the U.S. attack on Iran's nuclear facilities. Both of these are either friendly with Russia or former client states, as Syria was. So Russia would very much like to be back in the Middle East business. They would also like to establish a little horizontal leverage with the U.S. to balance out what's happening in Ukraine and the support that we're giving the Ukrainians, both the military and economic support, and also especially the intelligence support. The more leverage they can develop in Iran through providing capabilities and awareness, through various mechanisms to the Iranians, the more they might be willing to trade elsewhere. Just like Trump, they have a very good sense of where the leverage is.
We're almost out of time. You use the expression horizontal leverage. What does that mean?
Expanding negotiations, expanding the settlement for Ukraine into adjacent issues, right? Ukraine's their top priority, but if they can envision a settlement where there's certain Ukrainian issues that maybe are linked to certain Middle Eastern issues that are linked to issues elsewhere, I think that's something they would be interested in discussing.
Andrew, thank you very much. Andrew Peake of the Atlantic Council Scowcroft Center and a former senior official in both Trump administrations. Opening bells are next. There you have it, the opening bells on Bay Street and Wall Street. CoinShares is ringing the bell at the NASDAQ. Now, at the NYSE, it's a Coca-Cola bottler called Andina in celebration of its 80th anniversary. At the TSX, Long Point ETFs and Humilus Investment Strategies are doing the honors. It's time for the first 50. Well, let's check on how happy investors are today to hear there's a ceasefire in the Persian Gulf. The TSX jumping almost 2%. And look at the NASDAQ surging more than 3%. So investors happy to hear that the shooting is over for now, although terms of the ceasefire still unclear. As of yesterday, the S&P was down just over 3% so far this year. Toronto was up. Toronto doing pretty well, rallying almost 7%, helped, of course, by those higher oil prices. Couple of stocks of interest here. Let's have a quick look at Air Canada, because for air carriers, This is good news in the sense that fuel costs may well come down. And also, at times of war like this, people do tend to defer traffic or travel plans. So Air Canada stock, which has actually had a pretty good run over the past year, up about 7% today. Let's have a look now at a company called Blackline Safety. It is a maker of industrial equipment. Now, I don't know if our quote is upgrading right now. It provides wearable devices, for example, and sells gas monitoring equipment. It is going to be taken out. Yet another takeover of a TSX listed company. And apparently, it's the deal. There's various. It's complicated enough, but there's $9 cash consideration and total payment of up to $950. And the buyer here is an affiliate of Francisco Partners Management. So yet another company coming off the TSX. Let's check out some movers south of the border. We're joined by Keyera. I forgot to mention this one, and this is a fascinating story. The Competition Bureau has concerns about a deal that Keyera is working on. Keyera, or the Competition Bureau, has gone to court demanding documents or obtaining a court order to advance investigations into Keyera's proposed acquisition of the Canadian natural gas liquids business of Plains All American Pipeline. The Competition Bureau say both of these companies are important midstream oil and gas companies. They transport natural gas liquids, including ethane and propane. And the Bureau is worried that this could curb competition significantly in the Canadian oil and gas industry. Let's get some movers south of the border. We are joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, thanks very much for joining us.
My pleasure. Happy to be here.
Let's check out those airlines. And they're up. The energy stocks are down.
They're up extremely sharply so far today. They're the top performing stocks in the S&P 500, led by Delta Airlines. Not too far behind them, United and Southwest Airlines. All of these were up about 10% in the pre-market session. Definitely worth watching over the course of the day. Obviously, the 20% drop in WTI oil prices overnight as a result of the ceasefire, at least the 2-week ceasefire in Iran, is really lifting these stocks so far this morning. Worth noting, these stocks were down the S&P 500 passenger airlines sub-index was down 9.8% in the month of March. So there was a lot of bad news priced into these. Obviously, with rising oil prices, rising jet fuel prices, that was having a big impact here. And the stocks sold off quite dramatically. But today, bit of a relief rally, worth watching over the course of the day. Another group that is seeing a bit of a relief rally as well is the cruise lines, which obviously, like airlines, use a lot of oil products to move from place to place. So Carnival and Norwegian Cruise Lines were just behind those three airlines I mentioned in terms of the S&P 500 leaderboard today.
We'd seen a big run up in some fertilizer stocks, also chemical stocks, because of a cutoff in supplies from the Persian Gulf. What's the latest there? Is the rally running out of steam?
It certainly looks like it, at least this morning. Now, CF Industries, which is a large U.S.-based fertilizer producer, is the worst performing stock in the S&P 500 today. It was down about 10% in the pre-market session. It's worth watching over the course of the day. Now, I should point out, however, the entire year-to-date rally for this stock wasn't strictly related to the Iranian war. This is a stock that has been up 72% so far this year. About 30% of that has been since the month of March, or in the month of March, pardon me. So certainly they got a lift as a result of the Iran war, and the closure of the Strait of Hormuz obviously affected fertilizer shipments as well. However, it's not strictly related to that. These stocks have been up in the fertilizer space because there has been expected to be a little bit more of a rebound in terms of fertilizer demand this year. And so, while you are giving back a few of those gains in CF Industries and some of the other fertilizer names so far this morning, they are not at this point in any danger of erasing their year-to-date gains, which are still quite strong on the year.
Jeff, thanks very much indeed. Jeff Morgan of
Thank you.
Bloomberg. Coming up, some ideas for your portfolio amid all this turmoil. Stick with us. Let's get some ideas now from a portfolio manager who uses quantitative strategies, a crucial metric being momentum for stocks. We're joined by Shiraz Ahmed, CEO at Sartorial Wealth. Great to see you.
Thank you. Great to be here.
Straight off, what are your thoughts? And I know it's very early days on this ceasefire.
So, look, for the world, it's positive news. Obviously, for a lot of, depending on how you've been positioning your portfolios, it could be good or bad. So for a lot of the defensive or risk-off type securities, they're taking it on the chin a little bit today, and some of the risk-on are actually coming back.
Right. I mean, this is a situation which it's hard to discern momentum, isn't it? It's just so choppy.
Oh, very much so. So the volatility is through the roof, and that's to be expected in times of geopolitical risk.
Let's get to a stock that's an old faithful for many investors, Royal Bank of Canada. You like the look of this one right now.
Definitely, and we've been liking it for the last little bit. So over the past year, we've been in and out of it a few times. But that being said, we've actually taken a position recently, and we're a fan of RBC's kind of robust, banking opportunity. But it's not just pure banking; their wealth management side of the business and capital markets just provide a really stable business model overall. And again, it's a household name here in Canada, so it's a name that everybody should be familiar with.
Let's put up a 10-year chart. You think one beauty here, or your argument is that this is a compounder. It doesn't just go up and down with the economy.
Typically, yes, but again, it's obviously tied to interest rates. So a lot of central bank policy will be impacting the performance of the stock. But overall, it has been healthy and has done quite well.
You can see it drifted for a while there. Well, obviously during COVID, everything dropped, but subsequently people were worried about mortgage renewals.
They were, and so the loan loss provisions on all the banks' balance sheets were increased, and RBC was one of the ones that did the same actions as well. So that being said, it looks as though that some of those fears have been subsided, frankly, and we're positive overall on the stock.
Another name you like is ENI, E in New York, a major player, European player in the energy sector.
Yes, so this is, again, a bit of a energy sectoral play that we've done and in light of, frankly, recent volatility and momentum in the energy space. And obviously, it's coming off a little bit today. But that being said, for the past few weeks, energy has been one of the few beneficiaries of this ongoing geopolitical issue.
What about the company itself? I mean, the stock, obviously, it's had momentum over the past year. It's a double.
Absolutely. So it's had very strong positive momentum, and some of the screening that we're doing is looking at risk-adjusted return in both longer term and shorter term. And so it's screened very well, and it's a name that we liked and we wanted to add.
And Walmart, finally, a pretty obvious recession hedge. People look for lower prices in tough times.
Absolutely. And we're even seeing sort of the higher income segment of the population even looking towards Walmart as well. So they've been one of the bigger beneficiaries. Again, a very defensive stock that has done quite well in times of peril.
Let's try a 10-year chart for Walmart. I mean, one of the interesting things is they have made online work. They've been in this major battle with I think there's something up with our chart there. Some kind of data glitch. But in any case, interesting that they have managed to take on Amazon in the online space.
They've done a remarkable job kind of pivoting their business to be able to take on sort of the needs of today. And that's part of the reason why we do like Walmart. Again, in my practice, we're primarily momentum driven, but we do fundamentals on the front end. And Walmart has screened quite well in basically any way you want to look at it.
And it's interesting as well, advertising. They get so many people visiting their site that in some ways, they're a media company. They make money from selling ads.
It's definitely part of it's a line item on their balance sheet, for example. But that being said, it's obviously not their core of their business, but we do like how they are positioned today. And because we're momentum, we may be in today, we may be out, tomorrow or next rebalance. But that being said, at the moment, we do like Walmart.
And that's an interesting phenomenon. We've heard that higher income people who might before have thought, wow, Walmart's not for me, they're going there.
Absolutely. And it could even be for something similar to like groceries as a simple example. So you don't know which line item that is actually drawing them there. But the point is they're still seeing more and more of the higher income earners coming to Walmart.
Shiraz, thank you very much.
My pleasure. Thank you.
Shiraz Ahmed, CEO at Sartorial Wealth. Coming up, we got this ceasefire agreement. But is the deal in any sense a capitulation from Iran, or is it just aimed at saving face for U.S. President Donald Trump? Stick with us. So there's a ceasefire in the war in the Persian Gulf, but the disruption to the oil industry means we're probably going to be looking at higher energy prices for quite a while. The Prime Minister says the federal government is aware of high gasoline prices and he's, quote, looking at ways to help. Let's get more from Rachel Aiello of CTV News. Rachel, thanks very much for joining us. What is the Prime Minister actually saying right now about possible relief at the pumps?
Yeah, so the Prime Minister yesterday was asked by a reporter essentially what his message would be to Canadians who are facing around $2 per litre at the pumps. And Mark Carney said, you know, this is a result of it being a global market, but the federal government is aware that Canadians are paying more, facing the brunt of a war that essentially we are not part of. So he said that they are looking at how long this may persist and whether there could be something that the federal government could do to cushion the blow. Opening the door, I think the strongest comments from the Prime Minister yet on this file in terms of indicating that they are looking at ways that the federal Liberals could step in with some sort of relief for consumers, whether that's through ending gas taxes, a break on them, other direct-to-consumer relief. So clearly the Prime Minister is indicating here that he is open to the idea. And I think now, Andrew, the question would be what exactly is on the table and when could this relief be coming?
Why may the timing of this comment from Mr. Carney be significant?
Yeah, so there's a few things here that I think are worth noting. Obviously, the Prime Minister indicating they are, quote, looking at this comes on the heels of Conservative leader Pierre Poilievre coming out calling for a relief on federal fuel taxes, lifting the GST on gas and diesel. This is a push that he started last week, suggesting that because, you know, federal coffers, federal revenue is up as a result of high gas prices, that income, that revenue that the federal government has generated should be returned to the Canadians who are essentially paying it at the front end. So there is some political pressure growing on the Prime Minister in light of this. Obviously, as we're now watching unfold, Andrew, this morning, there is continuing fluctuation in the price of gas. Of course, there's a ceasefire now. Does that last? How quickly can oil flows get back up to what they were pre-conflict? All of these questions, I think, lead to why the Prime Minister indicated this is something they're waiting to see how long it persists. So timing-wise, I also think what we should all be watching for is come the spring economic statement that doesn't have a date yet, but will be the time, I think, for the Prime Minister, if he was, to advance any sort of cost of living or affordability measures, to come forward with it in that document. And between now and then, obviously, I think the Liberals in the Prime Minister's office, the Finance Minister's office, will be closely watching the markets, the situation, and will be able to gauge off of that where we are come that spring economic statement, how badly that gas tax relief may be needed.
Rachel, thank you very much. Rachel Aiello of CTV News. The Trump administration is adjusting how tariffs on key metals such as steel, aluminum and copper are calculated. We got more from Daniel Galley of TD. He argues that the global economy is in fact moving towards a wartime setup in which countries are anxious to stockpile materials. Daniel is Director of Commodity Strategy at TD Securities. Let's have a listen.
We're adjusting the way that we are accounting for the metal content in a very wide range of goods. And you have to remember, Andy, that we've adjusted these before. Aluminum tariffs in particular started off by including a smaller subset of HTS codes, the types of goods that would be tariffed upon entry into the United States, and were later adjusted to include more than 400 additional HTS codes. This latest announcement readjusts that framework and aligns it more closely to what the intent was from the beginning.
Right. Okay. So, yeah, it's not just a straightforward reduction. That's right. They're not, to some extent, they're not penalizing so strongly products that have just a bit of metal in them.
No, yeah, that's exactly right. And I think, you know, there can be some implications for fabricator margins, and we can get into that. But I think that misses the greater point here, that this adjustment once again reinforced this idea that the intent of this policy is to reignite American smelting. They have protected what you call the Midwest premium in aluminum markets, which is the additional price that you have to pay to get physical aluminum within the United States above and beyond the LME benchmark price. They've protected that in this adjustment, and I think that is the key here, that this is the intended policy. They want this price to be higher in order to incentivize new recycling capacity, to incentivize firms to reignite idle smelters, or even to invest in new smelting capacity within the United States.
You think that aluminum is a focus here? They're very keen to reinvigorate U.S. aluminum capacity?
Yeah, that's right. As you mentioned, in our view, we think everything we've seen in the last year suggests that the world is inching closer to a wartime economy. And let me be specific about what I mean here is that governments are prioritizing critical mineral stockpiling and industrial production in some cases. Aluminum seems to be in a special place where it's the only large commodity that is being prioritized within the United States for industrial production purposes. The reasons for why they might want to do that can vary. We can debate them, but at the end of the day, every signal that we have suggests that they do want to reignite American smelting when it comes to aluminum.
You think that we could be headed towards a crunch in copper supply?
Well, that's right. And copper is the other side of the story, right? This is one commodity that has been in focus for not only its implications on the data center build-outs, but the electrification globally. There's a lot of ink that has been spilled around the long-term supply shortfall. But in the near term, in the here and now, we think that copper inventories that are actually freely available for purchase have probably never been as low as they are today. And what I mean by that is that we have to account for the fact that some of the metal, even sitting in exchange warehouses today, is not actually available for purchase. Metal that is located in the United States is landlocked for as long as the threat of tariffs or potentially of export controls are going to persist. Beyond that, we have to acknowledge the fact that China's Strategic Reserve Bureau probably holds 40 to 60% of all global above-ground copper stockpiles, and that there is a minimum level that is necessary for the industry to function. Putting all of this together, you come up with what we would say is the unencumbered copper inventories, and they've never been lower than they are today, according to our estimates.
Never been lower. So I think, Daniel, you see a strong case for a rise in both aluminum and copper prices?
Yeah, that's right. Of course, the conflict in Iran can change that from a macro standpoint, and it is concerning to see, or that the market is rightly concerned around the prospects for global growth going forward if this conflict really does drag on. But if it doesn't, I think that thus far the evidence suggests that a geopolitical conflict like this one incentivizes more hoarding behavior from from nations, especially for a commodity as critical as copper. So demand growth in the here and now is actually not looking all that bad to us.
Yes, that's amazing, really. As if we didn't have enough disruption with the Middle East, we've also got these tariff considerations. Leave us with the final thought, Daniel, before we let you go. Gold stuck below $5,000. Do you think it could reignite again?
It is quite possible. So when it comes to gold, we think that there has been a step change in the pace of central bank and official sector buying activity. Because of that step change, which relates to the implications of the war, once again, Middle Eastern nations who are facing a large economic crisis are less likely to purchase gold. And nations that are paying substantially higher energy prices are also less likely to diversify away from U.S. dollar reserves because they need those U.S. dollars for their energy imports. Putting that all together, that just says that perhaps central bank and the official sector more broadly is going to buy slightly less gold than they did previously. But the implication here is that the institutional participation from investors, which has been extreme in our view, was left vulnerable to this, step change. So what we're seeing now is mostly an institutional repositioning borne by a shift in the fundamental outlook. But looking forward, that can also change. And we think, in fact, the conflict in Iran can both reignite central bank buying activity in gold in a bigger way, or it can continue to result in a fading trend as U.S. dollar reserves come back into focus.
Daniel Galley, commodity specialist at TD Securities. Let's check in on the stock market because we got quite the rally this morning. with word of this 2-week ceasefire agreement in the Persian Gulf. And you can see the TSX up almost 2%. We did see bigger gains. We have seen bigger gains for the U.S. markets. Let's have a look at the important U.S. benchmarks. Quite a jump there, almost a 3% gain for the NASDAQ, but the S&P up more than 2%. And let's have a look at oil, down sharply, as you might expect, with the removal, apparently, of threats to tankers going through the Strait of Hormuz. Whoa, look at that, down 18%. Sure implies that a whole bunch of speculator money may have gone into crude, plausibly enough, betting that oil prices were going to stay high amid this, what seemed to be an impasse between Washington and Tehran. We've got some stocks of interest here. Let's start off with CNQ, Canadian Natural Resources, down, as you might expect, sharply with this drop in oil prices. Another stock that's come under pressure right now, Methanex. Ivanhoe Mines, sorry, I forgot that. The copper stocks are on fire right now, moving up sharply because, of course, this removes something of the economic threat from the Strait of Hormuz shutdown. And we also saw a big rally in Hudbay Minerals, for example, as well. So the copper stocks jumping in trading right now. Up next, we're going to have more on this surge in North American markets. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. The US and Iran have agreed to a 2-week ceasefire, and Tehran has promised to reopen the Strait of Hormuz. Ship owners are rushing to understand the terms of the deal to provide an exit window for more than 800 vessels trapped in the Persian Gulf. Iran has agreed to safe passage in coordination with its armed forces and within technical limits. U.S. President Donald Trump says the U.S. will be helping with the traffic. Shares in Algoma Steel getting a lift. The steel producer has entered into a joint venture with Rochelle to create Rochelle Algoma Defense Solutions. Rochelle is an Ontario-based manufacturer of smart armored vehicles. The goal is to make ballistic steel for armored vehicles for Canada's defense industry. Companies say the steel can also be used in other industries, including infrastructure, marine, aerospace, and security. Shares in Keyera under pressure today. The Competition Bureau is moving ahead with its investigation into the company's proposed acquisition of the Canadian natural gas liquids business of Plains All American Pipeline. Both Keyera and Plains have significant midstream oil and gas operations in Canada, and the watchdog is looking into whether the deal will result in a lessening or prevention of competition. TSX moving higher amid investor relief that there's a ceasefire planned in the Gulf. Let's have a look at the U.S. markets. They are higher. In particular, both the Dow and the NASDAQ up almost 3%. Let's have a look at oil. It has been sliding dramatically today because it looks as though ships will be passing through the strait pretty soon. Let's have a look at gold. Now, you might think that people would move out of gold because they don't, because of reduced demand for a safe haven. However, gold is up, and that may be because lower energy prices mean less threat of inflation, and that removes or reduces the risk of interest rate increases. And finally, let's have a look at the Canadian dollar. Let's see how it's faring. And the Canadian dollar hanging in today, up 1/5 of a US cent. Traders moving back into stocks this morning, but will it last? Let's get perspective from John Zechner, chairman and founder of J. Zechner Associates. John, thanks very much for joining us.
Well, hey, Andy, good morning. And before we actually get to that, I got to say the announcement yesterday, congratulations. I mean, I came onto the air on this show, I think back when he came on air in 1999. And when it was still ROB TV, and I think you started coming on a year or two after that, as you know, as a swath of reporters that came over for on-air personality. So you and I have been talking for a long, long time, and appreciate it. You'll be missed.
Thank you very much, Sean, for those kind words. Yeah, you and I can hang out now. We can go causing trouble around Toronto during the day. Anyway, there's lots of uncertainty here. What's top of mind for you this morning after the ceasefire announcement, John?
Yeah, you know what? The markets have sort of expected this, Andy, to a degree. Even the rally into the end of the day yesterday, you know what it is? It's almost a year to the day that you had that rally off the Liberation Day lows. Remember, the market sold off so sharply in a week. Then that's where the whole taco phrase came in, because then he sort of put it off for 90 days. And I think everybody remembered that. So there was a real reticence to sell aggressively. When you think of it, for all the risk, for as much as oil prices went up and sort of the potential sort of major wars, I mean, the S&P didn't even drop 10%. So I think there was a real belief that, hey, this will, he'll do something. He needs an out, and he's looking for an out, and sort of got it to some degree this morning. I mean, probably why European and Asian markets are rallying even more than the U.S. because they suffered more, because they're closer to the action. They were impacted by the actual slowdown in the oil. So how do you manage this going forward? Well, I think for a while you've taken a major risk off the table for at least a short term. The whole idea of sort of a global Armageddon and the implications of that, and what to do oil prices and inflation, everything. We'll start to focus on what we focused on before, upcoming first quarter earnings reports. What's the next move from the central banks? How real is the SaaS apocalypse? What's the problems in private credit? It'll feel comfortable to go back to those old things. And in that regard, I mean, the market is a little cheaper than it was, Andy. We was trading about a 19 forward multiple now in the U.S., which is still not cheap, but it's better than the 23 times we came into the year at. So sort of picking our spots. Now, the only buys I'm probably looking at this morning is I think the energy trade is not over, and these stocks are getting a little whack today. And if you're underweight, or if you weren't really there, particularly on the oil producers, I'd be more inclined to sort of step in and make sure you've got something on, because as you've talked about, getting insurance, on freighters getting through the strait at this point, and how this ultimately settles out, and how you're sort of moving those supplies. There's still a lot of unknowns in the short term, and I think oil prices are going to hang in higher for longer, and that's just a beneficiary to the Canadian producers. We're not going back to $65 in a barrel in a hurry. Almost certain that. And the other thing too, Andy, I think is people are going to talk about global security of supply, and it's going to become very apparent that some of the safest long-term producers are North America.
John, I missed something there. You referred to apocalypse of some kind, a coinage. What was the worry there?
Well, just yesterday when you talked the obliteration of a civilization. I mean, when you have phrases like that coming out, I know there's a lot of bluster from Trump and all of that, but when the leader of the most powerful nation in the world says things like that, you got to sit back and take notice. And I mean, the plan as they had described it for what was going to go on last night, was pretty extreme. So, those risks are somewhat off the table for now.
John, let's turn to technology. You are in the camp that says Microsoft is a decent prospect right now.
I think, in this whole scenario that we sort of laid out, the one thing that has not changed is the rollout of IA, the implementation. And in the meantime, these stocks have been hit pretty hard. And you can buy Microsoft and Alphabet, a lot of those companies now at below market multiples, which has not happened, as I can recall, since sort of back in, well, maybe briefly in 2024, and before that, 2010. So it's been quite a while since you can do that. And the software stocks, I mean, there's an assumption that they're going to be sort of eradicated over periods of time, or they diminished in importance. And so I look at Adobe, Salesforce, Workday, companies like that, a Constellation Software up here. I just think those worst case scenarios are being priced into stocks. When you get that, you get the stocks a lot cheaper than you have in a long period of time. When you can buy growth companies that are growing faster than the overall economy at multiples that are less than the market overall, I think that's an opportunity, and I'd be more inclined to own those kinds of stocks right now than companies that are maybe dependent on global growth or North American growth. So I'd be lightening in the consumer sectors and maybe the industrial products and not as aggressive there, the rails, names like that, and. I think tech will be okay in all of this. I don't think put every last dollar there, and I think there was an unwinding of an overcrowded trade. But I think we've unwound a lot of that position right now.
Because we know that AI makes software easier to write in some cases, but there's lots of questions as to how reliable it'll be for multi-billion-dollar businesses with hundreds of thousands of customers. Can they trust AI?
Yeah, and how quickly the implementation will take place. I mean, as you say, companies have multi-millions of dollars invested in these systems. I do my payroll on ADP. I'm not about to change that. TurboTax for your taxes. I mean, you're not about to sort of go to Gemini and say, "Hey, can you do my taxes for me?" I mean, everybody knows. I mean, yes, it'll implement over periods of time. Maybe it'll be a productivity enhancing tool. In the meantime, the companies who can benefit most from it, who can roll it out profitably, I think are the hyperscalers and the major cloud companies that already have a great client base they can roll it out to. And I think in names like Microsoft and to a degree, Meta, I think they're right at the top of the list, Alphabet as well. So, and now you're getting them at a cheaper multiple. So yeah, this story will play out over time. I think where I'd be a little bit more sort of wary is maybe the chip stocks, because I don't know that they've maybe overbuilt. There's been a lot of front-end ordering, and it's always a very cyclical sector. I mean, it's sort of had a great tailwind for the last couple of years, but at some point, this CapEx will slow down, and when it does, their margins will come down, and the valuations are, to some degree, still relatively high. So I'd be probably a little more careful among those in that area.
John, thank you very much indeed. John Zechner, founder of J. Zechner Associates. Really appreciate it. Coming up, so we got the ceasefire. Is the deal a capitulation by Iran or just saving face for US President Donald Trump? Stick with us. US President Donald Trump says a 10-point peace plan that was put forward by Iran is workable. But our guest says she can't see how the US could agree to these terms. And she suspects the ceasefire certainly resembles Trump trying to save face. Let's get more from Besma Mamani, a professor of political science at the University of Waterloo and a senior fellow at the Center for International Governance Innovation. Thank you very much indeed for joining us.
My pleasure.
So Iran put forward these 10 points, and you say a couple of them that America could never really agree to. What are the most salient points here?
Well, I mean, really quickly, all 10 of them don't look like they're doable by the Americans. But the one that stands out: compensating Iran for war damages, withdrawal of U.S. combat forces from the entire region. Removing all sanctions. It's really quite difficult to see the Americans agreeing to this. So there's going to be some challenge here. These are 10 points that Trump alluded to, but has not gone into a lot of clarity about. The one thing he did mention to a number of interviewees is that he agreed to, or that the Iranians agreed to, removing all enriched uranium. So there's a real wide gap here between what's being proposed and I think where the reality of the two parties being able to meet on these points.
And President Trump says he has curtailed Iran's program of enrichment. Is there any truth to that, do you think?
Well, I mean, you remember that's what was said from last June during the 12-day war when the Americans hit a number of nuclear sites. So it's really unclear. Then, of course, when this war started again, there was reference to enriched uranium that was supposedly trapped, that was going to be potentially retrieved. We saw some reports on that by the Americans. So again, it's unclear. I think the big picture here is Trump was looking for an off-ramp. I think he thought his madman theory of proclaiming a lot of threats would, make the Iranians, I should say, crumble, and that didn't happen. And this is an unpopular war, pretty much on all fronts, particularly amongst the American public. And so it really required something of Trump to, proclaim mission accomplished without getting into the details. And that's what you have here.
Are the Iranians emerging as a winner here with de facto control of the Strait of Hormuz?
And again, that's another one of the 10 points, supposed 10 points, is that Iran will control the Strait of Hormuz and, again, presumably, put in some sort of toll system, which is what we have de facto happening today. Again, I don't see that happening. This is an international body of water that requires free shipping of movement, by international law. So again, that's going to be a hard one. In terms of, winning, it's really hard to say anybody won in the sense. I mean, there's enormous destruction throughout Iran today, not just in a lot of its critical infrastructure, but certainly a lot of refineries. I think the Iranian people are probably the biggest losers in the sense of having lost so much of their country's wealth and future prospective wealth. The Iranian regime, of course, is still standing, which, is to probably the chagrin of the vast majority of Iranian people. But the fact that they were able to survive is probably what, makes one to argue that, yes, in the big scheme of things, the Iranians won this particular battle because they were able to survive the entire onslaught of two very powerful armies.
What is the fundamental goal of the Iranian regime? I guess survival, obviously. Any power clique in power wants to do that. But of course, Iran is complex, isn't it? It has a whole secular political structure as well.
It definitely is, and it's a very multi-ethnic, multi-religious country. And I think that was the greatest worry of many, perhaps analysts and watchers, is to see the state crumble into a failed state. There are a lot of cleavages and fault lines that could be taken advantage of, particularly by separatist movements in the country. So the idea that Iran could collapse from within, which frankly, would serve nobody except perhaps the Israelis who are looking for a weakened adversary. The rest of the region would not want to see, or frankly, Europe or even the Americans, a failed state in the region, because we know failed states in the region from history tend to produce a lot of unintended outcomes for the region and for the entire world.
One of the important power dynamics, I guess, in the Middle East has been the face-off between Saudi Arabia and Iran. The two great powers in that region. Just enlarge on that. How is Saudi Arabia feeling about the current situation?
Well, I think they're relieved. I mean, most of the Gulf countries will be relieved. Yes, there is sort of a long-standing, antagonism between the two of them, but they have had sort of a detente since, I'd say, about the past 5 years. Mohammed bin Salman, for all his follies, has tried to cool things down on the foreign policy side and try to really focus on driving economic growth inside his country. There's a young, hungry population that wants to see a lot of economic growth and jobs, and certainly foreign policy wars and that sort of thing is not in their interest. So he's pivoted, I think, effectively for his country. But the reality is that the entire Gulf region does not benefit from seeing, again, a failed state in Iran, an antagonistic Iran. They have incurred a lot of damages to facilities, critical infrastructure, and even to their reputation as safe havens for the world to visit and to see. So they are very much relieved, I believe, in that this is over. Are they happy if the regime is in place? Well, I mean, if you had to choose between the regime in place or failed state, I think they prefer to see the regime in state.
Besma, thank you very much indeed. Besma Momani joining us there, Professor of Political Science at the University of Waterloo. Up next, Elemental Royalty has moved up to the Toronto Stock Exchange Big Board. We talked to the CEO. Elemental Royalty has its finger in about 50 cash-flowing mines and advanced development projects around the world. Its shares, as of yesterday, had more than doubled over the past year. Now, the company has just moved up from the TSX Venture Exchange to the TSX Main Board. We heard from David Cole, Chief Executive Officer.
So far, all royalties, and we've built this portfolio. And first of all, I'd like to say that that Elemental Royalty Corporation, as it stands today, is the result of a very nice merger that we're particularly pleased with between EMX Royalty Corporation and Elemental Altus Royalties, creating a new mid-tier company with greater mass on the books, more cash flow, et cetera. And to come into your question about royalties versus streams, to date, all we have are royalties on the books. But we are open to streaming deals going forward. But that speaks to how both companies have created the portfolio through purchase of existing royalties, royalty generation on the organic prospect generation side of the business, as well as a few royalty financings. And I think it is royalty and stream financings, now that we have more arrows in the quiver, more cash flow, is where we'll see some of our growth moving forward.
So you're not averse to streams as such?
We are not. It is somewhat fortuitous that we've gotten to where we are today with solidly the royalty model. Of course, royalties are phenomenal financial instruments, as I know you are aware. But we're open to streams and royalties moving forward, and we've got a treasury and a line of credit that facilitate those transactions.
You're an economic geologist by training. You spent actually 17 years with Newmont Mining in various roles. You've sold one or two companies since then. Tell us about your relationship with Tether, the crypto/blockchain company. They've got a pretty big stakeholding, more than 30%. How did that go?
That's correct. That's correct, Andrew. So Tether, one of the most successful private companies in the world today, and the largest stable coin company, and stable coin usage has continued to augment over time. USD stablecoin is their most prolific product, but they're expanding their XAUT, which is a gold stablecoin. They're very bullish precious metals. They're buying 2 to 3 metric tons of physical metal and taking delivery to their vaults and bunkers in Switzerland a week. And that is correct. You heard me correctly, 2 to 3 metric tons a week. So they're very bullish precious metals. They're converting fiat currency that they are making copiously in their stablecoin business and putting that into precious metals and precious metals royalties. We're delighted to have Juan Sartori as our chairman, representing that 32% ownership. And he has a strong outlook towards the royalty business in general. They believe it's one of the best business models in the world after the stablecoin business.
Do you ever get pushback, though, from investors saying, look, crypto, I find it hard to, I'm worried about the risks and the opaque nature. Do some investors, are they wary of that connection with the crypto stablecoin market?
You know, I've definitely heard some of that wariness in shareholder communication to me upon announcement of the merger and Tether's investment. But I want to make distinctly clear that there's a difference between crypto that is simply backed on a hope or an idea or faith, not dissimilar to fiat currency for that matter, if you look at it that way, versus stable coins that are backed by U.S. treasuries or XAUT, which is backed by physical gold in a vault in Switzerland.
You're very diversified. You've got, I think, just about every continent. You have royalties on either development projects or actual cash flowing projects. So you're happy with a diversified political risk around the world. You're not tempted just to focus, for example, on Scandinavia and North America.
Yeah, we do have a good focus in Fennoscandia, Canada, the United States, Chile, but we are in 22 countries, I believe, with nearly 300 mineral property assets across that. I've often been quoted as saying I believe political risk in the market is fully valued, and technical risk, geologic and engineering, and environmental risks tend to be undervalued as they're understood. And we're delighted to be able to mitigate that risk through the royalty model, through that portfolio diversification and the geopolitical diversification.
And can you just remind me, I forgot to check, are you paying we've only 30 seconds, are you paying a dividend right now?
Well, we're really proud of the fact that we just announced our inaugural dividend.
Oh, yeah.
And this was a novel dividend. We're the first company in the industry to offer XAUT, which is fully convertible into physical metal, as a dividend option.
David Cole, CEO of Elemental Royalty. Lots more coming up. We've got a rally in stocks on this temporary ceasefire agreement. Oil prices plummeting. We'll have more after the break. In a social media post, U.S. President Donald Trump is threatening 50% tariffs on countries providing Iran with weapons. However, he lacks the power to impose such levies after that U.S. Supreme Court decision that ruled out such tariffs. The announcement has also not been documented by the White House or signed by the president. Separately, Trump also said the U.S. is discussing sanctions relief for Iran, a key ceasefire demand from that country. Shares in Levi Strauss are up sharply, 11%. The maker of jeans boosted its profit and revenue forecast for the full year, and first quarter sales and revenue topped estimates. Levi says it's getting strong demand in all regions as it steers shoppers to its own stores and website. Separately, the company said its chief financial officer will be stepping down after more than a decade with the company. We've seen a rally in airline stocks today with this drop in oil prices. Shares in Delta are up 7%. First quarter profit and operating revenue beat analyst estimates. The company says demand has improved and bookings were strong in March. Premium cabin and loyalty-driven revenue cushioned the impact of higher fuel costs, which Delta expects to be more than $2 billion US. North American markets moving up amid relief that there's a ceasefire planned in the war in the Persian Gulf. Let's drill into this rally this morning after the U.S. and Iran agreed to the temporary cessation of hostilities, easing concerns over energy supply disruptions. We got more from Grant White, portfolio manager and investment advisor at IA Private Wealth.
We know that this is a very fragile situation. There's still ongoing conflict going on right now.
I know, we're still hearing shots fired as we speak.
Yeah, exactly. So it's very fragile. Everybody's saying it's fragile too. So the market reaction, I think, is fair because, if you go back to prior to this conflict going on, you remember the stories we're talking about? I mean, like AI security and things like that. That would be great if we could get back to those types of conversations, obviously. And so what the market is obviously hoping for is that's what we're getting back to, is the more boring stories out there. But yeah, so I don't think they're overreacting per se, but I do think that we are up for a roller coaster ride in this still.
Yeah, because we also saw quite a strong recovery last week too.
Yeah, exactly. And I think that was more of a reaction to the overreaction that's happened throughout this. I mean, nobody expects this to be a long-lasting conflict, especially given the pressures that the President Trump is facing back at home more than anything. And so I expect that this is going to be short-term. Hey, we all hope that this is the end of this coming up here, and certainly the market is showing that it hopes for that today. But I would say for investors out there, you got to be a little bit careful. Don't just expect that the story's done. There's a lot to get through here.
So what are you doing right now with all this, that's been unfolding? And on a day like this, are you jumping in, or are you sitting there going, hang on?
Yeah, well, I think for one, I'm glad that we're in because this is like catching a falling knife. It's incredibly difficult to catch a market like this, and the reality is, if you miss just like a few good days a year, your whole year could be shot in terms of market returns. And so this is looking like it's going to be one of the best days of the year, if not the best day of the year. And so hopefully you're invested. The key to all of this, and right to the beginning of this event, is that you need to stay invested throughout this, and a diversified portfolio. Particularly a globally diversified portfolio can help you to weather the storms and get through it. And then you get a day like today, and then you're participating in it, which is great. Because trying to buy into this market today, I think is going to be very difficult.
How have you done for the year? How are things shaping up with it?
Yeah, well, I'm pleasantly surprised, I guess, when we were looking at portfolios last week, and we were still positive on the year, given where the stock markets are around the world, and generally off 5 to 10%, give or take, which market. So pleasantly surprised that we were still hanging around the flat line there, and really well positioned for what's coming today and hopefully what's coming down the road this year.
Yeah, I was looking at your notes. What is it, 10 days if you miss?
Yeah. So if you miss just the 10 best days over 10 years, your portfolio returns could be cut in half over that 10-year period of time. So the key to all of this is you just got to stay invested. You got to stick to your discipline, stick with your philosophy, and no matter what's going on, don't try to catch the falling knives, as I said. Yeah.
I like that one.
Yeah.
So with that, does your philosophy change though? Like, does it change over the year? Does it change? Is it a seasonal to a degree? Like, obviously you're looking at how things are flowing, but also as you age, you're going to change what you need and what you want. Should you be adjusting that?
Yeah, I mean, you gotta adjust for your life for sure. And as an investor, that's what you should be focused in on more than anything, but not necessarily the seasonal change or what's going on in the macro environment. I think that what does change, though, is where the opportunities are. And what we have seen, and it's been difficult over the last couple of years with such dramatic growth, and especially a number of areas, it's difficult to find really great opportunities. Now, I mean, hey, war is bad and conflicts are bad, but when you look at what the market has done, just purely on the market, we have seen some opportunities come up in the last little while because prices have come back a little bit. Frankly, not as much as you might have thought or we might have thought could have happened, but that does bring opportunities into play, and so then we can pile into those opportunities and take advantage of lower pricing when that does happen.
What's some of the best opportunities you've seen over this last?
Well, some of the best names out there, I think, that have come back is names that are probably more boring. I mean, actually, one of the companies.
Sometimes boring is good.
Yeah, absolutely. I mean, one of the companies that we've been actually focusing on a little bit more is Canadian Tire. And because, like, in all the noise of AI, Canadian Tire has been doing a really great job of using AI to push up their revenue, to create better customer experiences. And so companies like that, I think, are really taking advantage of the new technology that's out there and improving their business. And so when you get pricing opportunities on a really boring company, like I say boring in the fondest way possible.
Yeah, it is.
You know,
the nicest way.
But it's like when you get an opportunity on a really great company like that, then that's great, you know, because otherwise you don't get the pricing opportunity that we've seen in the last while.
Grant White, portfolio manager and investment advisor at IA Private Wealth. Coming up, hot picks, we're going to zero in on 3 plays in telecom. Let's zero in on telecom in Hot Picks today. Our guest has Quebecor as his top idea. We're joined by David McFadgen, Managing Director in Institutional Equity Research at ATB Cormark Capital Markets. David, thanks for joining us. Quebecor is certainly shaking things up in the Canadian mobile industry. You like to look at the stock.
Yeah, it's my favorite name in the telecom space. So when I think about Quebecor, I kind of go back to what the company did in 2005 in the cable telephony market. So it entered that market from zero, and it came in with a low-priced landline telephony, cable telephony product. I think it was around $30 at the time. And Bell's ARPU was around 50, so that was its main competitor. And there wasn't really a lot that Bell could do because it didn't want to reprice its sub-base. Tried to compete on bundling, marketing, reinforcing the brand, but there wasn't really a lot it could do. Flash forward 10 years, and then Quebecor had 1.35 million landline telephony subscribers, generating over $200 million of EBITDA. So obviously very successful. I mean, it's since come off just due to the wireless substitution going on in the market, but clearly very successful there. So when I think about that, it kind of reminds me of what they're doing right now. So they've purchased Freedom. They're coming in the market with a very compelling product. So they're including roaming in all their plans. And so they're hitting the incumbents where it hurts. So the incumbents, right before COVID, used to do about $400 to $500 million a year in roaming revenue, very high margin revenue, by the way. And so by including roaming in all their plans, Canadians can travel the world. They don't have to worry about sticker shock when they come back in terms of a high bill. And so it's very appealing. And the incumbents, they don't want to match because who wants to see $400 to $500 million of revenue disappear, right? That's high margin. So Quebecor is doing very well. It's gaining share, and it's continuing to take share. And I expect that that's going to be the situation for many years to come.
You do also favor Rogers. Partly, you do see strong growth from that massive Shaw acquisition.
Well, I mean, Rogers, so all these guys, maybe with the exception of Quebecor, are looking for low single-digit organic growth. But what's appealing to me for Rogers is, so if you value the core business at around 7 times EBITDA, and you give zero value to the sports assets, then you get a target of around $50, which is kind of close to where the stock is trading, right? So the market's saying the sports assets aren't worth anything, if you look at it that way. Clearly, those sports assets are worth many billions of dollars. So we're valuing the sports assets at $11 billion, so $9.5 billion for the 75 interest in MLSE, and then $1.5 billion for the Jays and the other assets there. So if you give that value, then you get a target of where I get it is 74. It's obviously a very high target compared to where the stock's trading, but there's an event coming. They're going to buy out the 25% interest from Kilmer, so they're going to own 100% of MLSE. Then they're going to combine MLSE with the Jays, and then they're going to sell a minority stake in that. And so I think when you see a third-party independent player come in and put a value on those sports assets, put a marker on those sports assets, the stock is going to rally, because now we have an independent valuation confirmation, and the stock is very cheap. If you look at the multiple, it's trading around mid-6 times EBITDA, but it's actually cheaper than that because the sports assets don't really generate any EBITDA, right? So I think there's an event coming. It's going to happen this year, probably. Well, they're going to buy out some of this year. I think they'll probably do the minority stake this year as well on the combined asset. So there's an event coming here, and I think it will show that there is truly a lot of value in those sports assets, and the stock is really undervalued, in my opinion.
And then finally, BCE, the parent of this network, you think that stock is attractive. Why? I mean, given that there are concerns about price cutting in the wireless industry, why would you be a buy on BCE?
So I'd buy the other two first, but no, I like BCE. I think it's a very stable company. They've right-sized the dividend, so I think the dividend should be safe. They're focused on AI, clearly. Their goal is to generate $2 billion a year in revenue from AI by 2028. They did a deal recently in Saskatchewan. It's going to add a lot of, the forecast is $500 million in revenue out of that. So I see a stable company, low growth, but stable, solid dividend. But yeah, so we like it, but I like Quebecor and Rogers more, but I do like BC to recommend.
And just very finally, before we let you go, we're tight for time. What about TELUS? Do you favor TELUS right now?
No, I don't recommend TELUS. I think people are worried about the dividend. If I was the new CEO coming in, I'd probably cut it. I'm not saying they're going to cut it, but that's what I would do. Just because their payout ratio is over 100%. If they sell a minority interest in TELUS Health, then they're even more offside because now they can't access the free cash flow of TELUS Health. So, I'm not a fan of TELUS right now.
Thank you very much, David. Really appreciate it. David McFadgen of ATB Cormark Capital Markets. Just a reminder, of course, BCE is the parent company of BNN Bloomberg and will compete with Rogers, TELUS and Quebecor. Still ahead, our conversation with the president of Burger King Canada on the company's upgraded menu and what it means for the fast food industry across the nation. Just a reminder to tune in today at 3 p.m. Eastern to Know Your Options. You can get all of your options trading questions answered by Chris Tom of Moat Financial. Send your questions right now to knowyouroptions@bnnbloomberg.ca. Burger King Canada is making a shift in its core menu items, including its signature Whopper burger, fries, onion rings, and chicken nuggets. What does this say about the fast food industry in Canada right now? We were joined by Tom Curtis, president of Burger King.
Everybody's out there launching limited time offers from time to time. And really, the reason for being for Burger King is the Whopper, flame grilling, and having it your way. So I think leaning into those powerful equities is the right thing to do. This all started really 3 or 4 years ago when we started upgrading restaurants, operations, and franchisees, and this is the culmination of that upgrading or elevation effort.
That's great, Tom. I'm just curious on what's the main reason, like we were talking about, like especially younger customers and what the trends we're seeing. What's the main shift behind these moves today that you're seeing, and what are you hoping for the outcomes?
Yeah, so interesting that you mentioned younger customers, because when I travel, and I travel a lot, I'm getting on airplanes, I'm out and about in the markets, and a lot of people say to me, I used to love the Whopper, or my dad's favorite burger was the Whopper, and that bothers me. And so we really needed a signal to the market that we're worthy of a try from younger guests, from guests who haven't been to us for years. And I think that's why this is an important move for us.
And I mean, you're also facing the challenges with weight loss. I mean, there's a huge weight loss growth going on right now. People are staying away from fast foods, or the perception is they're staying away from fast foods. How are you bringing them back in?
So I think the key there is, we have our signature Whopper. We have the innovation around the Whopper, like a peppercorn Whopper or a maple bourbon barbecue Whopper. We make those available in our Whopper Junior also. And that's really our answer to this GLP movement. You don't have to sacrifice flavor and taste and quality because the Whopper's too big. It's available in a smaller package as well, and we're finding that consumers love that.
Tom, you should have sent some of those over so we could have tried them out, I think, You're
I know
obviously,
somebody will get it done.
Yeah. You're obviously, going into more premium, it sounds like more premium ingredients here, and I assume that has a cost factor assigned to it. My question is more about, do you see automation in any way being a way that you can help to manage costs as you're looking to put in more premium ingredients?
Well, when it comes to automation, period, we obviously are leaning into AI like everybody else is. But the way that we look at AI and automation is it's an enabler. It's not a replacement for labor. And I learned this at a prior brand that I was part of. If you enable people to be able to respond to increases in volume that always happen, then you'll grow traffic over time. And growing traffic is the only way to succeed in this business. Trying to cut costs is not.
Now, you mentioned about keeping staff. I mean, labor, though, is a huge cost, especially in Canada, minimum wages and things like that. How are you balancing that, keeping them, but still bringing in AI and automation?
Well, if you provide a great workplace, and we've gone from, at one point in 2018, to having 3% of our restaurants remodeled to now 75% and moving quickly toward 100, then you've got a great work environment. And once again, if you provide the technology tools that the workforce desires and wants and needs to perform their important tasks of taking care of guests well, then your workforce gets sticky. And then once again, when traffic and volume do increase, then they're ready to handle that. And you don't need to add a ton of additional labor to manage that.
Tom, just on the future of this, I mean, obviously you hope this is going to go well for you. What do you see the next steps following these moves are going to be, and what can investors look forward to?
Yeah, I think you would continue to expect for us to elevate across all fronts and all guest touch points. So there are other parts of the menu that could use elevation as well, because really, once again, long term, this is not, shrinkflation doesn't work. Cutting costs doesn't work. It might work for a quarter, it might work for a half, but it doesn't work for the long run success of the brand. So what you can expect to see, what you can expect to see in Canada is that the brand will continue to be a premium offering and something of a reward for people who want to access great food, but without sacrificing and also being able to get it at a reasonable price, because that's also the promise of the quick service business.
Now, I want to get back to AI. Right now, we're just talking about how AI. The concern is it'll affect brands negatively, but there is a space for people to take advantage of AI and strengthen your brand. How are you using AI, and what are you watching for that may hurt your brand, and how do you think it'll help your brand?
Yeah, so on the technology and AI front and how we're leveraging those to make our business better, we've developed a tool for our operators and our team members called BK Assistant. So if you can imagine just a headset that's talking to you all day and giving you the information that you need to provide a great guest experience. For example, hey, you're running out of a certain type of beverage, or your shake machine just went down. Can we call somebody for you to fix it? That's how we think of leveraging AI. If it's connected to all the different touch points in the restaurant, then people can leverage it once again to fix things, to help things, to make sure we don't run out of things. And then most importantly, our team members can focus on an interaction with the guest versus having to respond to distractions to that excellent guest experience. So that's how we think about it. Once again, I've had experience with this in a past life, and I know that's the best way to utilize technology.
My reading of that is you can have an AI jabbering in your ear as you're trying to deal with customers, but I may be missing the point there. Maybe that's a vision of the future. Tom Curtis joining us there, president of Burger King in Canada and the US. Yesterday on Market Call, we were joined by Colin Shazinski, portfolio manager and chief market strategist. The topic, a technical analysis. His top picks were Methanex, that stock is down today with the drop in energy prices, GE Vernova, and BMO Equal Weight Oil and Gas ETF, ZEO. Today on the show, it's the one and only Brian Madden, always dapper, always insightful, Chief Investment Officer at First Avenue Investment Council. And he'll take your questions on North American equities. Let's check in very quickly on the markets to see, is this rally intact? And sure enough, it is. The TSX up 1% amid relief among investors all around the world that a ceasefire is planned in the Persian Gulf. A lot of details unconfirmed, but Iran, of course, now apparently is envisaging charging tolls for ships using the Strait of Hormuz. So it was quite a jump in, let's have a look at the US markets, quite a jump in European stocks, as you might expect. France and Germany up almost 5% because the Europeans are particularly hard hit by this jump in energy costs. They get so much of their hydrocarbons via the Persian Gulf. Spanish stocks doing well. They're up around 4%. Same in Italy. The Brits up about 3%. And speaking of oil, let's see what's happened to that. This morning, we've seen a plunge in the price of crude. Now, it has bounced off the lows of the session, but it's still down significantly, up 15%. But you can see a lot of this rise in oil since the war started on February 28th is still in place. Oil energy is a lot more expensive. And remember, we're looking at US futures here, but this week, lots of energy consumers around the world were actually paying more than $140 US a barrel. Thanks for watching The Open. Morning Markets is up next.